So hopefully you can see my screen now. Again, apologies for the little delay, but we should be good to start. As I said, we've published the notebook for this webinar under the Alphien folder here, and it's called Parameter Tuning Webinar. So we'll directly load this and dig into the tutorial straight away. To give you a bit of context, this tutorial is about making sure that you have all the tools in order to have strategies that are going to be robust in the future, meaning that they will generalize and trade well on real markets. So digging directly into the code, as usual, we load the Alphien quantitative library through the source QLib, and then we'll start, as many of you are familiar, with creating a simple momentum strategy thanks to the algo engine object. So because my system is a bit shaky, I'm just going to run it on the Alphien Studio directly here. And so we will create this algo engine object. Very quickly, we invest in the bank ETF through the BB for the competition, and then we apply a very simple EMEA cross strategy. So this is a momentum strategy, and you buy it when basically the short-term momentum cross above the long-term moving average. So we have this object, which is an algo engine object, and we will try to optimize the way we pick the parameters of the strategy. So here we constructed the strategy. We can run the backtest, the performance, here's the output. However, when we did that, the initial building of the algo engine, we didn't really think about how we picked the long-term and the short-term parameters. And the question and the object of this webinar is to know how to do that. How do we pick these two numbers? We are going to use a way to help us do this with the build sensitivity method that comes attached to the algo engine object. So if I just paste in here this code, I will be able to directly from the algo engine object create what's called a sensitivity matrix attached to this object. So it will basically test a different set of values for the short moving average and for the long moving average. Here we see we have set the range from 5 to 60 and then from 200 to 250. And then we will try to see what are the results. So if I just take this line here and put it in my Alphien Studio, I can see directly the output here. If I zoom, the zoom is bigger, so it's probably better for you. It doesn't seem to work. Let me just view panes. Here we go. That's slightly bigger and better. So very simply, this is a two-dimension chart where we have the short moving average at the x-axis and the long moving average in the y-axis, and this is basically all the results on this metric that we have given, the Sharpe ratio, for all combinations. So the legend tells us that the darker it is, the better in terms of Sharpe ratio. We see that there are some clusters. Here it seems to be a good combination of things when you have a short of 6 days and a long of 221 days. Similarly, here it seems to be a cluster with a longer short-term moving average and a long moving average around 248, 250 days. So we will base our first intuition on these two clusters. See what we can do with that. Go back to the views here. Okay. So we have seen the sensitivity matrix, and from these we have already a good intuition of where we will put our parameters for our strategy. Now, the thing is, in this code that we've run, building algo engine, then building the sensitivity around those two parameters, and then visualizing this, the only thing we have done is run all possibilities on the backtest. Now that could lead to some problems in terms of generalization and robustness in the future, because we have basically chosen the best combination on all the data that we could see. So one approach to try and avoid, or actually try and mitigate this, to have like this extra information because we can see all the data, we can implement a train and validation set approach, which basically consists simply in splitting down your backtest period. So here, this is what I do. I take the bank building block, and I create two sets of dates, one for training, which is very simply only the first half of the data set, and the validation dates are the second half of the data set. So just by running this, we will have the option to again build a sensitivity matrix, but this time we will only optimize or only try all combinations on the first half of the data. So this will be modified so that it's only going to cover the first half of the data, and then we can simply plot it and then test up. You should see the updated version here. Yeah, that's an updated version. So we can see here that the shape is slightly different. There's much more clusters of working or darker Sharpe ratios here, and slightly less on the short term. So that's already helpful to tell us that we probably need to focus here in this zone rather than on the shorter or horizon. And then we can simply try the optimal parameter. So if you look into the console, each time I run the sensitivity analysis, the console outputs which parameters are the best. Here, the parameters are the best, 43, and then 248, 249, 250. So what we'll do is just construct this algo engine with 248 as stated here, and 43 for the short, and we will also want to check what the performances are, but this time not on the first half of the data set, but on the second half of the data set. So this is basically what I'm doing here. As I've changed my up, here we go. We can see the output of the strategy here, and it means that these are our results on the validation set. So this is a set of data that we decided on purpose to leave on the side and to check if the parameters we've picked here work well outside from the zone where we basically run our optimization. And we can see that the Sharpe has dropped, which is not surprising. It's actually expected. But on the original side, on the original results, the Sharpe was 0.36, which is normal because we have optimized on that. We have tried all combinations. We know that this works. However, outside from the zone that we know it works, obviously the results are slightly less good. It means that we have maybe picked parameters that worked very well on the zone where we looked at the data, but going forward in the future, we might not have as stunning results as we expected. So that's one way to double check if the way you've picked and fine-tuned your parameters is good. Let's go back to the notebook. As we said, 0.23 is slightly below what was obtained on the training data, but that's not to be, it's not very surprising. It's just like we need to be careful to not pick parameters that only fit the backtesting period. Now, from this initial analysis, I'm sure you've noticed that the output, it's no longer in there, sorry. The output of the sensitivity analysis is giving us a range here. It's telling us here is 43 days for the short-term moving average, and here's basically three set of days for the long-term moving average. Now we can think, okay, why do I need to make a choice and pick only one? Actually, our advice is not to do that. It's actually to use ensembling. So to use basically the set of three parameters in order to construct your strategy. So basically what ensembling does, or bagging, it's going to run three times the model. So this strategy is going to run three times. It's going to run with this parameter, then 249, and then 250. So at the end of the day, we'll have three different algorithm, if you want, and then it's going to be averaged so that we have a better behavior out of sample in the future. The strategy becomes slightly more robust. For those that are familiar with data science, it means that basically we are decreasing the variance of our model. So when we change a bit the parameter, the output changes less than if we had picked only one parameter, basically. So this is one technique. The handy thing is that Algo Engine already allows you to do this directly. Okay, just to show you here in my script. Here we go. Running this. I'm constructing the Algo Engine as usual. However, when I create my payout, I pass in a range of values in the long parameter, and then I have updated my my Algo Engine, and I can directly backtest. I've typed in backtest directly, but here we go, and I backtest. And this time I've used the 3 version of the EMA cross, and they have been averaged. They're slightly more robust. That's giving us obviously a slightly lower Sharpe ratio than if you use only the best combination, but this is to be expected because what we are looking for is not to get the best result in the backtest data, it's to get the best result outside, so in the future when we trade it in live markets. So this is one way you can improve the robustness of your strategy, and then on top of this you can run what we call time series cross validation, which is just a way to double check that everything has basically behave the way you would expect. Let me run this so that you understand what it does. And very simply, cross validation is a technique in data science to split a data set in subsamples, then run optimization only on one part of the subsample, and then test the results on the other part of the subsamples. So this, for time series, is a bit tricky. We need to use a growing window in order to keep the chronology in the data. Time series is all about chronology. The past is before the future. That makes intuitive sense, but also it means that the data is constructed this way, and we don't want to break that construction. So here, as an example, I've run this, and I'm going to try to just get this slightly bigger so that you can see plots. Okay, so okay, that's better resolution. So basically on these charts you can see that we have run the training here on this first initial window, and then we are running it on the validation part on the second part of the window. You will see also that the chronology, the x-axis is getting bigger. So here is only from 2011 to mid 2013, but here we include more data because the end is 2017 roughly, and here we include the whole data set. For this, I've kept a small portion of the data to train and then test the results on a slightly longer period. What we can see that each time in this bit, the training set basically, the value that we've optimized, which is the blue one, is better than the buy and hold. BH is for buy and hold on this part. So every time, obviously, we've run optimization. So it's not surprising that our strategy in blue is doing better than if we just buy and hold the asset. So that would be our benchmark. However, here, for example, the green line is the buy and hold. So if naively you're just buying here, and in purple you have our version of the model, and we can see that here we've made less money over this period than what the model suggested. Same again here. Obviously, during the optimization bit, we are above the buy and hold. Means that our model have some value. Obviously, this is where we've optimized it. However, in the validation, it was very similar, and then we actually outperformed the buy and hold. So it means that actually on a long period of time, we see some value in our model, in the one we have run on that. Here again, that's the full data set, and we can see the same behavior. Obviously, in the training set, we are outperforming the buy and hold. And on the validation set also, we are outperforming the buy and hold. So we are a bit more confident than that if we have a model that sees the data gradually, our model will have some value and outperform just the naive buy and hold on a long period of time. So let me go back to the usual view. This technique is called cross-validation for time series. So we have an expanding window where we just train on a small subsample, and then we test on the rest of the data. You can use this in order to double check that your picking of the parameters is not overfitting. So here, that your strategy is actually outperforming the buy and hold out of sample. You can see the metrics here that will tell you everything that I've just showed. What is your Sharpe ratio on the train set? What is your validation? What is your Sharpe ratio on the validation set? And for this very version, I've used 3. It's called K-fold. So I've cut the data set in 3, and then each time I've added one of the portion. So the first version here at the top is only the first sample, as I said, 2011, 2013, and then I've added the second sample, so up to 2017, and then I've added the third sample up to 2020, basically. So this is for cross-validation. Obviously, you can run that on the platform natively. This is not yet published, but if you're interested in this function, we can absolutely publish it for you. Just let us know, and we can discuss how you can implement it on your version of the payout. Lastly, I wanted to just run something from everything that we've seen. We've seen that we can natively use sensitivity matrix to pick the right parameters for out. Then we've seen that if we apply a bit of training and validation approach, then we have a way to gate the overfitting by picking not only the parameter that works well over the full data set, but maybe the one that works well on the full data set and is not far on the validation set. And we've seen also that you can use ensembling, so pick a set of parameters rather than using only one parameter in your payout in order to have a model that is more robust and more general. So what to do next? Very quickly, what I've done is I've run the same thing that I've done above, but for the 2 other building blocks of the competition. So same approach, we build the algo engine, then we run the sensitivity matrix, and then we pick the right parameters for it, and then I've rerun the algo engine so that it has the parameters that are optimized. I'm not going to show again the sensitivity matrix because it's pretty much exactly the same as what we've seen, but I'm just going to run the two versions of our single asset strategies for US high yield and for the US bond future. So again, building the algo engine, looking at the sensitivity matrix, and then picking the right parameters for this asset. So I'm just going to run this. And now what we've done is we have the 3 building blocks for the competition. So the first example was on banks here at the top. Is the first one we've done. And now it's just created the one for US high yield and the one for Treasury futures. And these 3 versions of our initial momentum strategy, in EMA cross, have been optimized so that they perform the best, basically. Now we can do a grouping and create a portfolio out of them. So you know that if you create algo engines on the platform, then you can directly pass them in the portfolio method. So here we go. I just run this, and I'm going to combine the 3 optimized version of my momentum strategy with an ERC weight payout. So as we've seen in the latest webinar, the one about portfolio optimization. By the way, this is available on the wiki, on the website, and on YouTube if you want to see the replays. But the ERC weight is optimizing the portfolio by allocating assets the same amount of volatility, basically, in time. And then we've seen also that we can pipe it, we can combine it with the minimum rebalancing frequency function, so that I'm not overpaying in rebalancing costs. And then I evaluate it. So this is basically what I've done. And then we can run a backtest on it to see what our results are. So I've called it my P. Here we go. So this is the results of our backtest. Okay, so not too bad, I suppose. 4% annual return and a Sharpe ratio of 1.8. So if you want to compare that on where this would put you on the leaderboard, you go to competition here and you check the leaderboard, and you are roughly in the top 10 strategies, with a strategy that took us only 20 minutes to build. So that's pretty good. We are top 10 just with this, and we have only used basically functions or payouts that are already available on the platform, EMEA cross, and for the portfolio ERC weight and minimum rebalancing. So that's promising. We have done only optimization on long and short, but you can come with other parameters. Here we've looked at long for ensembling, for example. Maybe you can do the same for short, and also you can try the same techniques with another payout than EMEA cross. For example, if you want to build some sort of risk reversal strategy, you can use RSI signal, which is one of the payouts that is available on the platform. So that's how you would combine everything that we've seen into a portfolio, and we've seen that the results are pretty good for the amount of effort that we've put into it. However, it's not where it stops. We have seen that we can do ensembling, and that the performance is going to be stable on the long run, more stable in the long run. But what we've done in all the previous steps that I presented was to pick a set of parameter. If we go back to here, I've picked here the range. Sorry, I've picked the range 238 to 240, and here I've just picked 5. But this is very static. So what I mean by that is, once I've picked this, it never changes, and it runs forever with these parameters. However, intuitively we might think, okay, this is an approach that does not really allow us to adapt to periods that do not look like the past, basically. So the parameters are set, they never change. Maybe we can think of an approach that would be adaptive, that would adapt to the new data that comes in, and that would change the parameters depending on this market regime that the data show us. When you have the prices of an asset that comes in every day, obviously the time series grows, and the regime can switch from a high volatility regime to a low volatility regime, for example, and your behavior should adapt to these sort of changes. So here I've just created the function called EMEA optimize. So again, we're going to use this example here to illustrate what we can do. And basically, try to decompose this function, but basically what it does is I give it a building block name and then a bunch of parameters. And the key parameter here is that it's going to optimize. Sorry, I'm not sure. It's going to optimize on the. I'm not too sure why this behaves this way. Optimize every 250 days, and I'm looking back at a window of 1,000 days, basically backwards. So I'm going to use basically 1,000 days in order to assess what my optimal parameters are. So this is what we do. We call the prices, and then basically here in line 64, we start to adapt. So we are going to basically go through the data set in a rolling fashion, and every 250 days we are going to rerun the same optimization that we've seen previously, which is the build sensitivity one. So we are going to every 250 days build this matrix and pick the long and short parameters that give us the good result on that window. And then, because it's going to happen every 250 days, our model is going to adapt. It's going to change its parameter automatically as we go along. And this is a behavior that we might want to implement. So I'm just running the function here. This is just an illustration, but the message and the idea behind this is really to be adapt to new data and to new market regimes. So here, if I just run this, so at the end of the day, this function here is a payout function. It's creating a signal. So if I just show you, it's going to take a bit of time to run because, as we said, it's going to build this matrix every 250 days. We are getting rid of the first 1,000 data. So it's going to do that roughly because the backtest period is 10 years. So it's going to do this probably 8 times. Yeah. So it's going to take a bit of time. If you run it in the Alphien Studio, you can see here all the logs. So you see that it's finished running on the first window, and it's had an optimal Sharpe ratio of 0.52, and the best parameters for this were 20 for the long term and 20 for the short term EMEA and 143 for the long term EMEA. So it's going to go through the whole data set like this, and it's going to adapt, it's going to change its parameters as we go forward. Obviously, when new data comes in, then this continues and the parameters will adapt to new data. Let me just take this line and show you that what the results are. So as I said, this function is returning a signal. So it behaves like a payout function. At the end of the day, we'll have dates with a buy or stay flat, basically allocations in time. And we will hope that this behavior has a good outcome on our strategy. I've run this function on TY, so I'm just going to show you the result of a backtest on TY when we have this signal. So I think it still needs a bit of time to finish. Just a note about the tool you're using. As you know, in Alphien, you can use either notebooks like this or Alphien Studio. Be aware that if you use notebooks, all these interactive messages are not showed, because here the console is showing you interactively what the output are, and that could be good to understand the behavior of the function and see how it changes from 18 to 15 to 19 to 19. So it's an interesting thing to see, and Alphien Studio is the way to see this when it runs. Notebook is slightly different, more about documenting the results. So this has finished running. So now I have my signal. I told you that I would show you that it looks like basically a payout. Okay, here it's 0. I can show you a bit more. Okay, so the payout changes in time. So that's exactly the behavior of a payout. So we can backtest it on TY, and here is our backtesting result. We can see our strategy, which is adaptive. It has picked the optimal parameter across the time of the backtest here. It's doing pretty good. It's outperforming the underlying at the end of the day, and it's limiting a lot our drawdowns. So it's limiting our risks basically. You can see that the Sharpe ratio is 0.6 roughly, but our maximum drawdown is only minus 3.6%. So this is a nice way to try and think about how do I adapt to new market data coming in, and how do I make my payout general enough so that it can handle new market regimes, even if it never saw this market regime before. So this is pretty much it for the content of this webinar. Let me just go through a quick conclusion here. We've seen a few techniques to fine-tune your parameters. First, you could use a train and validation approach or time series cross-validation to assess whether the way you've picked your parameters is optimal but not too optimal, if you've not just overfit, or if you not just use parameters that have a high value in your backtest but zero value in the future. We've seen also that to try and mitigate this, you can use ensembling or bagging, which means putting together different versions of the same payouts. We run it with our long moving average between 248 and 250, for example. So we had 3 versions of the same payout, and then average the results so that we have something that is more robust. It reduces the variance of your payout, meaning that even if there is a high volatility in the input, so if the prices change a lot, the behavior is less volatile. The behavior of your model is less volatile than it would be with only one parameter. And then the last thing that we've covered is the adaptive technique in order to compute the optimal parameters. So the gist here in our function to optimize the moving average is really to think of doing optimizing in a rolling fashion, selecting a set of past values to do our optimization, and rerunning that optimization quite often in order to adapt to the current regime that our data is in. That's pretty much it for this webinar. Obviously, we will publish this notebook. It's already published here, but we will also publish a version in Alphien Studio that you can use directly or copy the code to get started. We've seen that just with this, without any effort, you can create a portfolio that would rank roughly top 10 or 11 in the current leaderboard. So that's minimal effort, and then you can start from there and improve and make the fine tuning better using these techniques. Maybe using more model in your ensembling model, or maybe checking that the cross validation is running on more subsamples and that the results are stable in time. That would be a good way. So that's it for today. Thanks for attending. Obviously, I'm opening the floor to any questions if there are. Please let us know.